In this video, I'm going to share the one thing that separates real estate investing from other types of investments like stocks, bonds, or cryptocurrency. It's something that makes real estate really shine. My name is Dan Calonge, and I help immigrant professionals achieve long-term wealth through passively investing in real estate. If you'd like to receive my free passive investing guide for immigrant professionals, please click below in the description. So, what's this one thing that I'm talking about that is so incredible about real estate? That one thing is taxes. All right, before I go any further, full disclaimer, I am not a CPA or a tax expert. The information I'm sharing here is just information that I've learned through reading, watching podcasts, and just absorbing information about how taxes work with real estate. Before making any decisions based on the information I'm sharing, please do talk to your own tax professional or CPA about how this information might return to you specifically. Now back to the video. Taxes are your biggest expense in almost anything you do. In your W-2 as a professional, in your investing, taxes are always the biggest expense. They just are. And they can eat a big chunk of your earnings. Make $100,000 in stocks, you get taxed. Make $50,000 in Bitcoin, you get taxed. Make $150,000 in real estate, you get taxed. But is it really taxed? Let's talk about that. Now, of course, we all know we pay taxes through our W-2 jobs that we have. And, that's all common knowledge. But did you know you also get taxed on all your investments? You probably did, or maybe you didn't, but it's good to know. Now, some people don't think taxes are very cool, but I do. Why is that? Because it's our number one expense. So any way I can legally reduce my taxes is something that's got my attention. So why does real estate get preferential treatment by the US government? Well, it's because they want us to invest in housing, offices, factories, things that serve the population and propel our economy. It's that simple. And the people that do this are entrepreneurs and investors. While real estate does get taxed, it's the tools the US government gives you to legally reduce your taxes that makes it so interesting. Those include deductions of all types, but none as powerful as depreciation. If you don't know what depreciation is, it's a certain amount of monetary value that you can deduct over time due to wear and tear. I remember first hearing about this and being confused as exactly what it was. So today I want to give you an example. All right, so this concept is most easily explained through an example. So see here, there's a home. Let's say you purchased an investment property for $500,000. And let's assume that 15% of that property price really is the value of the land. So in essence, the building and everything sits on top of the land is $425,000. So that amount is what's depreciated over 27 and a half years. Why 27 and a half years? Because that's the IRS term that they defined for residential properties. So let's look at it graphically. So if we apply straight line depreciation, which means we basically divide the $425,000 by 27 and a half years, we get something that looks like this, where we're getting depreciation of about $15,000 a year, starting from year one all the way through year 27 and a half. How does this look when it comes to income? So let's see how it's used. So let's say in year one, you had net income of about $20,000. Now, that's your rents, all your revenue, minus any expenses you had. Let's just say it was $20,000 just to make it easy. You can apply the depreciation of $15,000 for that year because you have $15,000 available. You apply it for that tax year, which leaves you with $5,000 of actual taxable income. And that's what's taxed, that $5,000. And depreciation that remains is zero because you've used up the entire depreciation for that year. Year two, same thing. Let's say you make another $20,000 and you have $15,000 available of depreciation for that year. You apply that full $15,000 and you're left with $5,000 of taxable income. And that is what's taxed. And you can see it keeps going, years 2, 3, 4, 5, etc. Just keep going through. And if the net income was the same, you'll have the same $5,000 taxable income at the end of the year. So in this case, you're paying taxes, you're just paying less. Instead of paying taxes on $20,000 of income, you're paying taxes on $5,000, which is a big difference. So the straight line depreciation example is pretty simple, right? Now let's talk about something that many real estate investors use and many actually don't know a whole lot about, which is something called a cost segregation study. Now, what is that? It's essentially a study where somebody looks at your property and says, well, okay, these things can be depreciated over an entire 27 and a half years. That makes a lot of sense. But there are some things in the home that can be depreciated faster. Things like countertops, things like flooring, things that may not last quite as long can be depreciated at a faster rate. So this study basically says, okay, this amount of money of asset can be depreciated over 5 years or over 7 years or over 15 years instead of the 27 and a half. And what this does is it basically front loads a lot of the depreciation up to the very beginning, which is when you can make the most use out of it. So let's go back to our same example to see what that looks like. Now here's an example of what happens to depreciation when we use a cost segregation study. As I mentioned before, you basically take things that depreciate faster and you apply that to those pieces of your property versus the others, and you delineate it that way. So in this example, I'm going to show you what this example looks like. Now, this is interesting. Now, as you see, within the first 5 years, we've got $31,000 worth of depreciation we can apply. From years 5 through 15, we've got $14,000 of depreciation. And then for the rest of the years, we've got about $10,000 in depreciation. So you can see that these first 5 years are heavily loaded up front because there are things that can depreciate much faster that we're bringing into this, so that we can apply a $31,000 loss, let's say, versus what we had before was 15. So that's a big difference, and this really increases the tax benefits to you because you get more of that up front. Let's look at what this looks like in terms of income. So let's say we're back in our same example and we made $20,000 of net income, but this time we applied this cost segregation approach to depreciation. The depreciation available in year one is now $31,000, not $15,000. It's more than double, which is really impressive. Depending on your income, obviously, that's going to help you a ton. So $31,000, you can apply $20,000 worth of it because that's how much income we made. So you essentially have zero taxable income for the year. And that $11,000 of depreciation that remains carries over to the next year, which is really cool. Let's look at year two. So year two, we have that same $20,000. We have $31,000 again for depreciation, but we have $11,000 we're carrying over from the previous years, so that's $42,000. And then we're applying $20,000 worth of it because that's the income we made. So we have zero taxable income, and our depreciation that remains is $22,000. And this continues over the life of the property. So year 4, year 5. Now what's interesting, after year 5, your amount of depreciation actually decreases. So you can see the depreciation available starts to drop a little bit because it's less than $20,000. And year 7 drops again. But you can see the big benefit here is that you're front loading a lot of this in the beginning, which is really powerful. So pretty cool how that kind of a study can basically front load a lot of depreciation up to the very beginning. Now there's one thing that's going on right now in 2023 that you should know about when it comes to depreciation that's even better, if you could imagine that. So back in 2017, Congress passed the Tax Cuts and Jobs Act, which was probably the biggest rewrite of our tax code in 3 decades. And one of the things that it did was that it allowed you to take bonus depreciation. So basically anything that's not the 27 and a half years can be front loaded up to year 1. In 2022, that was 100% of all that accelerated depreciation gets brought to year 1, which is amazing. Right now, I'm recording this in 2023, so right now it's 80% of that depreciation can be brought up to year one. The rest of it has to be applied as it was before. In 2024, it'll be 60%, then 40, etc. So right now in 2023, the 80% applies. So let's see how this is applied using the same example that you and I have been going through so far. Now here is an example of what the 80% bonus depreciation means and what it looks like. So the bonus depreciation, again, if you recall, is the depreciation that was applied in years 5, 7, 15, etc. So it used to be around 31,000. We took 80% of it and 80% of the 15 year, and we applied it all in year one. So year one gets $119,000 of depreciation. So much depreciation, I can't even show it on this graph. That is amazing. And this really front loads this depreciation up to the front. Now, again, as a reminder, this is 2023 that I'm recording this video. And the plan right now is 2024 will be different. It'll be 60%. So in 2023, 80% bonus depreciation is what applies. And it's a really powerful effect. Let's look at how this looks like in terms of the actual income of the property. So same example here, we made $20,000 from net income, but now look at the depreciation available, $119,000. That's unbelievable. Imagine if you had a much higher income in this property, you could really depreciate, you could basically write off all of it. In this case, we're going to stick with $20,000 because that's all we made, and the taxable income is zero. We have $99,000 of depreciation left. If we go to year two, that 99 carries over, and now we're starting to apply depreciation, the rest of the 20% basically that wasn't applied, plus the straight line. So now we're at $13,000 of depreciation that we're adding on to that 99. We take 20,000 from that, we have zero, we're still remaining with 92,000. And it just works itself that way. So you can see that we're still at zero taxable income, which is really cool. But the thing that's really interesting is that now we've really boosted and front loaded this depreciation to the very beginning of the entire cycle, which is very powerful if you're trying to apply this to earnings that you have. So I hope this short video helped illuminate what depreciation is and how it's used in real estate investing. It's important to note that the depreciation approach that I mentioned to you applies not just to a single family home, but applies exactly the same to a large apartment complex or multifamily property. It's just the scale is different, but it's the same concepts apply to both. And this is what makes real estate investing so powerful for professionals investing passively, because you can get these benefits without actually having to manage it yourself, which is incredible. So we spent this video talking about depreciation and how that works. One thing that I haven't addressed in this video that we'll talk about in a later time is what happens when you're going to sell the property. What happens to the capital gain, like the profit you make? What happens to that depreciation? It turns out there are some really important strategies that you can take to make sure that you're addressing that situation to have you come out in the best way possible in terms of your taxes. So stay tuned for that in the future. Hope this video helped. If you have any questions or you want to leave any comments, please do so down below. And thank you for your time.